So let's get going. What does it really mean when I say over-the-counter versus central counterparty? Well, let's focus on the left-hand side of this slide. Over-the-counter is how foreign exchange trading really started. So think of when you read A, this could be Goldman Sachs, B could be UBS, C could be Morgan Stanley, and then basically all the banks in the world, whenever they had a need to exchange currencies, they leveraged their existing network of relationships, and rather than exchange those currencies by an exchange, which we'll see in a second what that means, they basically had bilateral deals that were signed over the counter. That's what the OTC thing stands for. And basically UBS just said, hey, I need to sell 1 billion of dollars because I'm short of euros. Who wants to trade with me? And they would then engage in a bilateral transaction whereby somebody wired euros and dollars back. And that was that. Now, interestingly, the number of relationships there is pretty much exponential in the number of participants, because you can see there are n times n minus 1 cross relationships here. So Goldman Sachs here would have to have open dealings with F, E presumably, although I apologize, I should have had a line here which is missing, D and so on. And contrast that with the way an organized exchange works. And in an exchange, what happens is rather than A speaking directly to, say, E, what A does, for instance, with stock trading would be, if I want to buy some Apple shares, then I would just go to the relevant market and enter them into the order book as a limit order. And then if somebody had entered a limit order of opposite sign, then the centralized counterparty, which acts as the middleman between all parties, would basically match both, and a trade would take place. Now, sounds all very trivial, but as you can see here, the number of relationships here, this is a hub and spoke model, is a lot smaller because everybody is just dealing with the exchange. And there are a lot of interesting corollaries to this. So far, so good? By all means, any questions, I remind you, use the chat thing, and I'll be trying to take them. And if I know how to answer them, it'll be my pleasure. So let's get going. So I just grab this thing of Investopedia just to let you know how different assets are currently traded. So if you think of regulated markets, which is what I would call an exchange, you can see that obviously exchange-traded funds are traded on regulated markets. You have options and futures, which are, again, traded in regulated markets. Common shares used to be just traded in regulated markets, and then you could argue that the whole mess has started and people started creating dark pools and so on. So there's also over-the-counter trading for shares, even though it used to be on exchange. And there are other various instruments. If we move over to the right-hand side, to over-the-counter markets, you see that typically bonds, which are typically more complex, and there are more types of bonds. They are more difficult to standardize. If you think of a share is a share. There's no shares with different maturities, whereas Apple might have 55 different issues of, well, Apple is a bad example because they're making so much money they don't need any debt, but there could be banks who, or even countries who issue tons of bond programs, each with, say, 30-year maturity. And then, of course, as you go along, then you have, 15, 20, 30 different bonds outstanding from, say, the Kingdom of Spain, which is very hard to put on an exchange because you need critical mass to standardize everything. Same goes for even money market products, where you have the shorter duration debt and so on. And interestingly, the question is, and this is a big question, how come Forex, which is really about the most liquid and standard plain vanilla asset class in the world, how come something which is so easily standardized isn't traded on exchange, but rather is traded over the counter, as if a lot euro-dollar was different from a lot euro-dollar, which is different from a lot euro-dollar. They're all the same. How come euro-dollar is not just listed as a futures contract, given it has leverage on an exchange? Well, there are reasons for that in the interbanking market, mainly to do with history. But I will argue that there are more reasons behind the history, and that is that in over-the-counter markets, if you're the clever guy, if you're the Goldman Sachs, and you get away with listing things on a bilateral basis, because you're typically smarter than the counterparty, or you have more means than the counterparty you're facing, it's in your interest to keep things over the counter, but it is not in the interest of the weaker party to the transaction to stay over the counter, because then they take a lot more risks. And those are the following. Well, actually, I just jumped ahead of myself. So if you guys don't know how an organized market works, I'll just do a 3-minute summary here on how order matching in an exchange works. What you have is you have the ask volume. So people who are on the ask, they will enter their limit prices on, and there will be software aggregating all those limit prices in descending order. So the further you get away, the further the price is from the, as you can see here, from the current market price. And then the market price really is the result at the top of book of where bid and ask meet. So at this point, the small differences between 44.60 and 44.66. This is just a screenshot of some share. I don't even know which one I picked it of. And what you have is people entering orders on the bid and on the ask all the time, both limit orders, which you can think of, stop losses and take profits, and also market orders, which would just try to hit the bid. So if I was going to ask for money at 44.60, I would just enter a market order and I would take this volume of 2,049 contracts outstanding. And if I was first to the order book, then the trade would be mine. Okay, and all this is happening because all the orders, and this is important, everyone's limit orders are put into a single order book. What does that have to offer to traders? Well, everybody is trading against everyone else, which is on the one hand tougher because there are no silly puppets in the market, but it's also fairer because it's first come, first served. If you're first to hit the order book, the trade is yours. Very importantly, it's anonymous. Nobody could reverse engineer who it is that they're trading against because everybody is hiding behind the identity of the central counterparty. So what does this mean in practice? I'll just give you an example. So let's just take the world of poker, okay? If you were the world's best poker player and you were just going to like some small-time country and wanted to make a killing off the back of poker, would you like people to know that you're the world's best poker player? Come on, prices. Live account with Darwinex funded for whoever answers here. Come on, here we go. Oh, there you go. So you wouldn't want that to know because then people would perhaps not dare trade against you. That's the bad thing. Or even if you're looking at a market as big as this, they could do something even worse. They could just try to copy whatever it is you were doing to free ride of your skill. So you don't, if you're a good trader, you really don't want to know. So you don't want people to know what it is you're up to because, there's all sorts of bad things that happen when you do that. And that's, for instance, one of the reasons at Darwinex where we offer what people think of as a copy trading service. But the last thing we will ever do is tell people what your live trades are, because if they knew them, they could copy them without a profit for you. So very important one. A CCP is an anonymous venue. And last but not least, this is a bit of a more complex technical issue, but the issue of counterparty risk, which we'll get into in a second. What it really means is if there is counterparty risk, counterparty risk is the risk that the other side on your trade defaults on its obligations. Put it another way, if you're making a killing on the Swiss franc, as say some Alpari customers were doing on the day where the Swiss franc went 1 out against the euro, then the last thing you want is for the people taking the opposite side of your trade to go bust because you're rich on paper, but you're actually just feeling like a moron because the profits are just not there when you want to cash them out.